Hello, in this video I'm gonna walk you through the financial model Excel template. I will show you the main inputs, the core outputs, reports and charts. So let's get started. On the dashboard you can input core inputs, timing assumptions, debt assumptions, equity waterfall assumptions, and then see the core financials and profitability chart by years. So let's begin the setup of the model from the timing assumptions. Once you click at any yellow cell, you will see this notification window, which will explain you what you are supposed to input here. I believe it will help you to understand model drivers more and easily navigate across the model. So let's start from the construction start date. So you can just use the drop down and set, for example, April will be construction start date. The debt assumption construction loan will also launch the same date, by the way, which is connected to the construction start date. And the next step is to set your operation start date. Means that the first month when your hotel will start to generate revenue. Let's pretend it can be June, for example. Then you have hold period, for example 110 months, and sale date is calculated automatically depending on hold period in months and construction start date. So in this case this is June 29. If I will input, for example, 80 months of hold period, you may see that the sale date will be December 26, so you should not input anything for last 3 years, which are 27, 28 and 29. Only input these yellow cells. Let me switch it back. So the next step is to input count of rooms in the hotel, for example 300, and then we need to define the occupancy. This is average occupancy by years, which will be adjusted by ramp up and seasonality, which I will explain a bit more later. So let's pretend 75% of occupancy for the first 5 years, then it will be 77% of occupancy. Then you can input occupancy ramp up in months, for example 3 months. It means that first month will be 33%, then 67%, and starting from the third month you will have 100% of your average occupancy. The next step is to set up your average daily rate by years, for example $100, and each next year plus $5. The next step is to set up the food and beverage revenue per room and other revenue per room, both per month. If you don't need one of them, you can just clean it, or clean both, or you can adjust in the same way as I just set up the average daily rate. So it can be $30 and each next year plus $1 per month. Then based on these assumptions you have the outputs of revenue per available room and total revenue per available room by years. The next step is to set up the reserves, which will be calculated as a percentage of revenue. So this can be reserve for replacement, for example 3% of revenue per month. Then you have debt service coverage ratio, which depends on your revenue, expenses and debt assumptions, which I'll explain a bit more as well. You have output for construction costs, which will input on construction cost sheet. Loan to cost ratio, which will impact your construction loan, for example it can be 65%. Occupancy ramp up, we just discussed it. You can input exit cap rate, which will impact your sales price, for example 7%, and sales expenses, 2% of your total sales price. And you can see the 3 outputs, like sales expenses in dollars, total sales expense, and net sales expense. So once you set up all the revenue, seasonality, wages, and expenses assumptions, you see the core financials by years and review the profitability chart by years, which includes departmental revenue, the EBITDA, and EBITDA percentage. On the top right section of the dashboard you have equity waterfall with IRR hurdles, assumptions and outputs. So you have 4 sections here: equity contributions, promote structure, partnership level returns, and property metrics. So under equity contributions, you should set up the allocation between general partners investors and limited partners investors contributions. So let's pretend general partners investors share is 5% and other 95% is for limited partners. To the right you may see the calculation of amounts for these contributions. On the next section you can input the promote structure assumptions, which is hurdle 2, 3 and 4 IRR. So let's pretend for hurdle 2 there are hurdle will be 7%, hurdle 3 12 and 16 for hurdle number 4. And you have the GP promote depending on hurdle 5%, 10 and 15 for example. So you may see to the right how this promote impacts the shares of general partner and limited partner. So for the hurdle 1 you have 5 and 95, which is equity contribution share. For the hurdle 2 you have 9.8 and 90.3%, 14.5, 85.5, 19.3 and 80.8%. The next section will show you the partnership level returns, which is cash outflow or cash contributions, which is the same amount, 28 and 536,000 here. You can see the profit broken down by limited partner and general partner, the IRR percentage, and multiple on investment capital or equity multiple. You can see also some property metrics for the acquisition and exit, like purchase price per room and total, purchase price less debt proceeds per room and total, exit sales price per room and total, and finally net sales proceeds per room and total as well. On the equity waterfall tab, you may see all the calculations by months for the equity contributions, promote structure, so you can see the net cash flow for distribution, summary of investor level returns by months, return of capital and hurdle or preferred return, hurdle 2 calculation, hurdle 3 calculation, hurdle 4, some return metrics and some risk metrics. On the KPIs tab you may see the main investors KPIs and outputs, which are partnership level returns, property metrics, property level return metrics, and sensitivity analysis. Under partnership level returns, all KPIs broken down by limited partner and general partner KPIs. You may see the cash outflow or cash contributions, profit, IRR percentage, and multiple on investment capital or equity multiple. Under property metrics you may see the acquisition and exit KPIs, which are purchase price per room and total, purchase price less debt proceeds per room and total, the sales price per room and total, and net sales proceeds also per room and total. Under property level return metrics you may see the KPIs broken down by unlevered and levered cash flow, which are IRR percentage, multiple on investment capital, total cash invested, total revenue, total profit, and cash on cash return or average free and clear return. On the sensitivity analysis tab, you may see the different scenarios of your metrics like IRR, multiple on investment capital, and profit, depending on different hold periods and exit cap rates. So these yellow cells are changeable. For example, you may say the middle point for your hold period 80 months. So you'll have scenarios for hold period 56 months, 68 months, 80 months, 92 and 104 months. Also you can set the middle point for your exit cap rate, for example 6%. So you'll have scenarios for 2, 4, 6, 8 and 10% of exit cap rate. On the sensitivity tab you may see the values for your IRR depending on these exit cap rates and hold periods. If you would like, you may see the profit amount. Let's give a couple of seconds to update this tab, so you may see different profit amounts depending on the exit cap rate and hold period. Also on the top left cell you may see the profit calculated by the model. The same way you have multiple on investment capital scenarios. So you can see the value calculated by the model and different scenario assumptions and outputs. On the income statement tab, you may see the main line items for your profit and loss, which is departmental revenue, which includes rooms revenue, food and beverage revenue, and other revenue, departmental expenses, rooms expenses, food and beverage expenses, and other expenses, total departmental profit. Then you have undistributed expenses section, which includes salaries and wages and other undistributed expenses. Then you have gross operating profit, management expenses, total fixed expenses, your EBITDA, total depreciation and amortization, reserves for replacement, EBIT, interest expenses, net operating income, gain/loss on sale, and net income. Also, each section, as you may see, have this plus button. You may click on this plus button and see the detailed breakdown of each section by its subcategories, for example, like for departmental revenue and for departmental expenses. On the cash flow tab, you may see the operating activities, investing activities, and financing activities broken down by subcategories and broken down by months. On the cash flow statement in indirect method, you may see the same operating, investing, and financing activities, but in more collapsed form, which is easier to review. And on the balance sheet, you may see the main current assets, non-current assets, current liabilities, non-current liabilities, and your equity. The summary of these three statements you may see on the summary tab, where you can see the income statement is the main P&L line items for the 10 years, and here you may select specific year and see this year by months. The same information you may see on the charts below. Also, you may see the balance sheet with the main KPIs for the 10 years, and for the selected year broken down by months is the charts, and the cash flow statement also broken down by 10 years, and for the specific year broken down by months. On the top revenue tab, you may see the revenue breakdown by three main revenue streams, which are rooms revenue, food and beverage revenue, and other revenue. Also, you may see the breakdown of absolute values by years and percentage allocation by years. The same information you may see on the charts below, where you may see the percentage breakdown and absolute values breakdown by years. The next set of charts will show you the revenue depths and monthly run rate for the specific year, so you can select, for example, 2022 and see the absolute values of revenue breakdown and percentage allocation on the pie chart. On the revenue bridge, you may see the main drivers of your revenue growth between these 2 years. So, for example, I can set 2021 till 2028, and you may see on the left side total revenue for the 2021, on the right side total revenue for the 2028, and the main drivers of revenue growth, which is rooms revenue, food and beverage revenue, and other revenue, and absolute values of this revenue growth. Top expenses tab, you may see top 4 expense line items and all other expenses collapsed into one line, which is other here. Also, you may see the absolute values breakdown by 10 years and percentage allocation broken down by 10 years. The same information you may see on the charts below, where you may see the percentage allocation and absolute values allocation by main expense categories. On the expenses depths and on monthly run rate chart, you may see the specific year broken down by absolute values on the charts on the left side and percentage allocation on the pie chart. On the expenses bridge, you may see the main drivers of your expense growth. So, for example, I can select 2022 till 2027, and on the left side I may see the total expenses for 2022. On the right side I may see the total expenses for 2027. And in between you may see the main drivers of this expense growth, which is salaries and wages in this case, property tax, lease and rental expense, interest expense, and other with absolute values on this chart. On the Charts tab, you may see the main financial KPIs on a graphical form, which is 10 years broken down by months. On the top, you may see the net operating income by months. The next chart will show you the EBITDA breakdown, which consists of departmental revenue, departmental expenses, salaries and wages, unstructured expenses, management fees, and fixed fees. And finally, as a result, you may see as a blue line the total EBITDA by months. The next chart will show you the operating cash flow, broken down by cash inflow and cash outflow. The next chart, average occupancy rate by months. The next chart will show you the revenue breakdown, which is rooms revenue, food and beverage revenue, and other revenue. The next chart will show you the revenue KPIs, which are revenue per available room and total revenue per available room. And finally, you can see the construction cost breakdown by months. And the breakdown is acquisition and land purchase, soft costs, hard costs, and other costs. The color coding in the model is very simple. You may change any yellow cell in any yellow sheet within the model. This means that this yellow cell has some input, assumption or driver which impacts the calculation within the model. Blue sheets means that on these sheets there are some charts, reports, and other information which can be useful for reporting purposes. On the tabs without color, you have some extra calculations related to revenue, to debts, equity, inventory, and everything which is needed for the reporting. Additionally, you have Contents tab, which allow you to navigate across the model very simple. So you may click on any report and you can go back. It is broken down by reports, assumptions, statements, and setup. There is short explanation about what each tab does, but if you want to know more, you can go to How To and to see more detailed explanation of what each tab does and what inputs you may find on this sheet and what kind of outputs you may find on this sheet as well. Any header of this section is also clickable. So you may click on, for example, Book Assets, and you go directly to this tab. On the Seasonality tab, you may input your room occupancy rate seasonality factors. So here you may see this yellow line. Let me explain you how it works. So this factor works as an adjustment. So for example, if we set up on the dashboard the average occupancy for the year 70%, for example, if I'll put -5% for January, this means that I will have 65% of occupancy for the January. If February -3%, for example, then 67. This works the same way for all other months. On the chart below you may see the seasonality factor adjustment. Also here you have the gray section with the calculation of actual occupancy by months and years. As we also set up on the dashboard July as a start of operational period, all the months before July 20 have zero occupancy, obviously. You have some ramp up period on the dashboard. It is shown here. This means that only in December, which is month number 7, starting from the operational start date, you have the full ramp up, and you may see the impact of the occupancy factor on each of the months by years and by months as well. On the construction costs tab, you can input your construction expenses broken down by 4 main categories, which are acquisition and land purchase group, soft costs, hard costs, and other costs. So each category has its own subcategories. First line item for the acquisition land purchase is defined for the land purchase. So you should not change this name here, it is gray, but you can change the spending, for example 3 million, or even 0 out if you don't need to purchase the land. You have also some predefined subcategories, which are most typical for each of the groups, but you can change these names as well, or even remove these line items if you don't need them. So let me show you how it works. So first of all, you need to set up, as we just discussed, the category name, then you should input the spending. Next, you have different growth methods. You have up to 4 different methods, and I will walk you through one by one. So for example, if you will select the straight line, first of all, it's the simplest one. You need to set up the start date and end date. By default, the start date is connected to the construction start date, and end date is kind of 3 months here, but you can change it to 6 months or whatever amount of months you need. So if you select the growth method as straight line, you will have the straight amount, just these 3 millions broken down by 9 months. You have also check here to double check that this amount and amount by months is the same. So it's just easier for you to understand how it works. The next way is steady growth. So you have steady growth each month. First month is around 67,000, the next 133,000, 200,000. Let me show you how it works if I will insert here a small chart for better understanding. So this is steady growth. If I will select the bell curve, I need to input the bell curve shape. You may see now this cell is yellow. This means that I need to select something. By default, you will have some curve, but you can change it to spiky. You can see that this is spiky bell curve, medium, less spiky, and flat. So this is more flat bell curve. So these amounts are spread here. And the final option is to select as a growth method custom. So now you have this line as inputs. It's yellow now. Check is not okay because we need to spread this amount. So I can input 1 million here, another million here, and another million here. So now check is okay. So it's kind of more manual or custom way to input your spending by months. Obviously start date and end date is also not needed here because you input everything manually. So let me change it back. I hope that makes sense. The same idea for all other soft costs, hard costs, and other costs. And as a final result, you have the total construction costs and its breakdown by months. On the DUM expenses sheet, you can input your departmental and distributed and management expenses. So let's go one by one. Under departmental expenses assumption sections, you have 3 categories: rooms expenses, food and beverage expenses, and other expenses by default. But you can also rename, you can type any name you would like. Here you may see the approach of how it will be calculated. So for rooms revenue, it will be calculated as a percentage of rooms revenue. For food and beverage expenses, it will be calculated as a percentage of food and beverage revenue. And for other expenses, it will be calculated as a percentage of other revenue. We also have notification in these yellow cells of what you are supposed to input. So you can input, for example, 3, 4, 5, 5, 5, 6, 6, 6, 7, 7%. Or keep it steady across all the years, for example, 7%, like here. Under undistributed expenses assumptions, you have 15 categories. Some of them are defined, but you can change the names as well. For example, instead of utilities, you can type other undistributed expenses or any other name you would like. The idea is the same, but all undistributed expenses will be calculated as a percentage of total departmental revenue, which is a total of rooms revenue, food and beverage revenue, and other revenue. The same idea for management expenses. You have 4 different approaches here: as a percentage of total departmental revenue, as a percentage of rooms revenue, and as a percentage of food and beverage revenue, and finally as a percentage of other revenue. By default, you have management fee as a one line, but if you have different approaches for the calculation of management fee, you can use up to 8 different lines here. So below you have the basis for the calculation of all three categories of expenses, which is revenue, broken down by rooms, food and beverage, and other. Then you have departmental expenses by line items and by months, and distributed expenses by line items and by months, and management fees. Finally, in income statement under departmental expenses, other undistributed expenses, and management fees, you can see the detailed breakdown with line items and with the detalization by months. On the Fixed Expenses tab, you have 25 placeholders to set up your fixed expenses line items. So let me show you how it works. First of all, in the categories column, you need to input the name of this fixed expenses line item, for example, utilities. Next column is launch or start date. By default, this is connected to the operation start date on the dashboard, but you can change it as well, for example, December 20. The end date is also connected to the sales date on the dashboard, but you can change it, for example, January 29. Then you have 8 different periodicity approaches, so let me show you how it works one by one. For example, one time, you're spending of $1,000. So obviously, if you select it one time, you don't need end date, just one date and one spending. So you have in December 20, $1,000. The next, you can select the daily basis, and you will have $31,000 because in December you have 31 days. Then January is 31,000 again, February is 28,000, etc. till the January 29. So the January 29 is the last date when you have this category of fixed expenses. Another option is weekly. In this case, you will have 4 payments each month, 4,000 per month. If you will select bi-weekly, you will have 2 payments roughly each month, so in this case you will have $2,000. In case of monthly, you will have steady $1,000 per month till the end, which is January 29. In case of quarterly, you will have 1 payment per quarter starting from December 20. As you may see here, if you will select semi-annually, you will have 1 payment per each half a year, starting from December 20. And the last approach is yearly, you will have $1,000 each year in December. Additional cool thing which you have in the model, this is yearly growth rate. For example, if I will select monthly, August 20 for example, and I want to add 5% of growth the next year, then 4% into 2022 and 2% each next year. So you may see that starting from January 21, you will have instead of $1,000, $1,050. Then in January 22, within the year, you will have $1,092, and etc. till the end of the model. So you'll have steady growth of this fixed expense by years. And finally, in income statement, in the fixed expenses category, you will see the breakdown of your fixed expenses by line items and by months as well. On the wages tab, you have 19 placeholders to set up your staffing assumptions. So let me show you how it works. On the categories column, you need to set up the position name, for example, CEO. The hire date by default is connected to the operation start date on the dashboard, and fire date is connected to the sales date on the dashboard as well. But if you need, you can use the drop down to select the needed date. For example, for CEO, the hire date will be May, and the fire will be still the sales date. Then you need to input the annual base salary, for example, $50,000. The next step is to set up your monthly bonus, for example 5%, and payroll tax rate, for example 12%. In the next section, you can input the staff count or FTE count, so it will be 1, for example, across all the years. Let me give you another example. For example, manager. You want to start hiring in September 20, and June 28 will be the last date or fire date. So you may see immediately 29 is gray here, so you don't need to input any FTEs here. So the annual base can be, for example, $40,000 is 3% of monthly bonus with the same 12% tax rate. You want to hire 2 in 2020, 4, 6, 8, 10, 12, and steady 12 till the end of the model. So additionally, you are able to set up the annual salary rise position or annual salary growth. It can be, for example, 5% across all the years. So below you may see the calculation of your annual salary, depending on annual base and depending on the salary rise percentage. Below you may see the total headcount calculation or total FTE calculation by months, calculation of salaries by months, bonuses by months, and payroll taxes. And finally, in income statement, under salaries and wages category, you may see the breakdown of your salaries and wages by positions and the amounts by months. In the top right corner of the dashboard, you have 3 placeholders for the debt assumptions. First line item is predefined for the construction loan. So you have the total construction costs, which I'll explain a bit more and which you will input on the construction costs tab. So you have loan to cost ratio, which is 60% in this case, and the total amount of construction loan is $3.8 million. The launch date also connected to the construction start date, so you should not change this date in this case, but you can change the full term in months, which can be, for example, 80 months. The interest only period, which can be 10 months, for example. For this period you will not pay any amount of the loan, but you will pay only interest. It can be 5 months, for example. Then you have the interest rate, which is annual interest rate, can be 10%, for example. And you can select the type, which can be usual or annuity. You have also another placeholders to set up, for example, construction loan 2. So you can input some amount, $100,000, some launch date, for example, April 20, some term, 60 months, the interest only period, it can be 0, for example, or 3 months. Again, annual interest rate, 12%, and the type can be usual. So in income statement you may see the interest expense calculation. On the cash flow you may see the interest paid under operating expenses, and under financing expenses you may see the total debt drawdowns and total debt repayments. And finally on the balance sheet, under non-current liabilities, you can see the total debts outstanding amount. On the Assets tab you have 7 placeholders to set up your assets categories or groups. First 2 lines are predefined, which is land cost and other construction cost, and these costs are linked to the table of construction costs. So the land purchase amount is 2 million and everything else is in the second line item, which is other construction costs. Obviously land cost should not be depreciable, so useful time years is 0. So you may see in here the calculation of capital expenditure and the closing net book value, and no depreciation for land. For the second line item you can input some useful time in years, for example 25 years. So you may see the capital expenditure by months, you may see the book depreciation and closing net book value. Also you have 5 different placeholders for other construction costs or assets, for example asset 2. So you may input some purchase date, for example May 20, 1 million of asset costs and 5 years of useful time. So you may see below this asset 2, 1 million spent in May and the depreciation for the next 5 years, and closing net book value for the next 5 years. So in income statement tab, we can see the total depreciation and amortization amount by months. On the cash flow, you may see the fixed assets capital expenditure by months. And on the balance sheet, we can see under fixed assets the closing net book value of these assets. On the top of the dashboard, you have currency and denominator assumptions. So let me show you how it works. First of all, you have a section with currency inputs and currency outputs. If you would like to see all the model assumptions and outputs in the same currency, for example in United States dollars, you can just keep default values and keep exchange rate as a default as well. But for example, if you would like to input all the assumptions in United States dollars and see the outputs in euros, you need to input the currency exchange rate in this case. This can be 1.2 for example. So what happens? In all the reports now you can see the numbers in euros. The same for charts and all statements like income statement, cash flow, balance sheet and all other reports. Another cool option is to use denominator. By default you have 1000. What does it mean? It means that for the all reports and charts you have $1,000 as a denomination. Means that this is in $1,000 or euros in this case. But if you would like to see it in millions, you can just change this denomination and instead of thousands you will see millions. You can use just 1 and you will see in dollars, so no denomination applied. I hope you enjoyed my video. Thanks for reviewing this. You can find more on my website finmodelslab.com, and we'll see you later in the next videos.